Welcome back. Our next guest is confident Venezuelan oil is not going to substitute Canadian oil at U.S. refineries, at least not in the short term, but could have a significant impact on Alberta's economy. For more, let's welcome Charles St-Arnaud, chief economist at Servus Credit Union and former Bank of Canada economist. It's good to have you join us. Thanks so much.
Good afternoon.
So let's start. Why don't you think in the short term the Canadian oil market really has any concern?
Well, in some ways, its geography is very, in some ways, benefiting Canada. Is that when we look at Canada's oil exports, yes, more than 90% are going towards the U.S., but it's where in the U.S. they're going that is important, and whether or not they can be displaced by Venezuelan oil. So right now, about 70% of Canadian oil is being exported to the refineries in the Midwest. About another 10% is going to the Gulf Coast, and another 10% is going to the West Coast. And at the moment, the only place where Canadian oil could be displaced is really at the Gulf Coast, where the U.S. could import oil directly from Venezuela to use in those refineries. So that's about 10% of the Canadian exports. And that oil that arrives from the Gulf Coast cannot at the moment travel north toward the refineries of the Midwest, because currently the pipeline system is meant to bring actually Canadian oil from the Midwest to the Gulf Coast. And then when we look on the West Coast, the refineries, especially in Washington State, are actually being fed through a branch in the Trans Mountain system. So they actually have direct access to Canadian exports. So it will be very hard for Venezuelan oil to actually reach that region. So that means that in the very short term, only about 10% of Canadian oil exports could be affected by the increase of production in Venezuela.
When it comes to long term, though, what does that look like? Like, are you expecting more infrastructure to be built to get Venezuelan oil to those other areas of the U.S.?
Well, that's I would say the billion-dollar question is, one, are the U.S. Oil companies, will they be willing to invest massively in Venezuela to increase the production substantially? Because at the moment, Venezuela produces about 1 million barrels per day of oil versus Canada exporting 4.5 million barrel of oil to the U.S. So it's almost 5 times more exports from Canada than what Venezuela can produce right now. So they will need to ramp up that production to be able to displace more Canadian oil. Then from there, is there an incentive to actually bring that oil to the Midwest? Is the pricing is good? Is the investment in the pipeline infrastructure favorable enough to actually justify that investment? So that's why in the short term, it's very hard for Venezuelan oil to displace Canadian oil. In the long term, if the economic incentive are there, it's a possibility.
But even in the short term, I mean, you mentioned that 10% that could be replaced by Venezuelan oil going to the Gulf Coast. Like, is 10% a lot when it comes to the Canadian oil market? Like, could that do a lot of damage still to particularly Alberta?
Yeah, well, when we look at it in the grand scheme of things, it's about a value of a loss in terms of exports of about 13 billion. For Canada as a whole, it's not great, but it's still manageable. It's when it comes to Alberta, we're talking to almost a hit of about 3% of GDP. So that will have some very significant impact or some important impact on the economy. But the other impact also would be what happens to the oil price differential, where having that competition between Venezuelan oil and Canadian oil will likely lead to a wider discount on Canadian oil and will have an impact on pricing. And that will have, again, more impact on the economy, but also a lot of impact on the fiscal situation here in Alberta.
No kidding. And we've, of course, got the renegotiation of the free trade agreement coming up this year between Canada, the U.S. and Mexico. Oil for Canada was one of the big key components, one of the big leverages that Canada has in these trade agreements. How might what's happening right now between Venezuela and the U.S. affect that in terms of Canada having something to offer?
Yeah, well, it changed, but only at the margin the leverage Canada has. I think now the U.S. can really play the card that, hey, we have access to all those reserves, so we don't really need Canada. But in some ways, the Canadian government can actually call in some way that bluff, because the US will require immense investment in Venezuela to actually increase production enough to displace Canadian oil. So, and that's not a guarantee yet. And we also have to keep in mind that the more we produce that oil in Venezuela, the more likely we'll continue to contribute to the current oversupply in oil that will probably last for longer than what is expected. So with those low oil prices, will the financial incentive of actually producing more and committing more investment money long term will make sense for the big American companies.
A lot to watch for. That's all the time we have, but appreciate you coming on and sharing your insight. Thanks so much for your time.
Thank you for having me.
That was Charles St-Arnaud, chief economist at Servus Credit Union and former Bank of Canada economist.